SEBI, the market regulator, has just rolled out a bunch of changes to how futures and options trading will work. The idea? Make our markets safer, clearer, and harder to manipulate. Let's break it all down simply. First up, how SEBI measures trader activity. Earlier, they just counted how many contracts were open. That's called notional open interest. Now, they're moving to a smarter method, delta-based open interest or futures equivalent OI. This isn't just about how many contracts are out there, but how risky they really are based on price movements. The result? A better risk picture and fewer unnecessary bans on stocks. Next, let's talk about trading limits or market-wide position limits. From 1st October 2025, these limits will be based on real market activity. SEBI will now use the lower one of the two, 15% of a stock's free float or 65 times its average daily cash volume. This means limits will reflect how active a stock truly is and help stop manipulation. Now, here's good news for traders. From October, if a stock is in a ban, you can still place trades that reduce your risk, like closing or balancing your positions. Until now, exchanges checked limits only once a day. But from November 3rd, they'll do it 4 times a day randomly. So if anything crosses the line, it can be caught on the spot. Let's move to index trading. SEBI has set new limits. For index options, 1500 crore rupees as the net end of day limit and 10,000 crore rupees as gross limit. For index futures, 15% of open interest or 500 crore rupees, whichever is higher for big institutions. And for others, 5% or 500 crore rupees, whichever is higher. These will be phased in between July and December. For non-benchmark indices, from November 3rd, they must have at least 14 stocks, no single stock over 20% weight. Top 3 together cannot exceed 45% to be eligible for F&O trading. Now, how much can individuals and companies trade in a single stock through F&O has also been revised. 10% for individuals, 20% for proprietary brokers, and 30% for MFs and FPIs. The small window before regular trading starts is now being extended to current month futures, both for stocks and indices. In the last 5 days before expiry, it will also apply to next month futures. And lastly, mutual funds and alternative investment funds will also have to use the delta-based method to calculate risk in options trading. Found this video helpful? Hit subscribe and stay tuned with Business Standard for more such easy to understand market updates.